Welcome to the deep dive. We cut through the noise and get right to the heart of the matter. Today we're diving deep into the world of digital business finance, and we're doing it with the insights of Professor Sergio Antunes. You're probably wondering, who? So we'll get to that. We're looking at actual course notes and examples from his course.
Finanzas y planos de negocios na nova economia, which translates to finance and business plans in the new economy.
Right, so you're essentially getting a sneak peek into how an expert actually teaches this stuff.
You'll learn how to size up digital businesses, how to build a solid business plan, and even how to get funding from investors.
That's great. So about Professor Antunes, he's a fascinating character. He's an electrical engineer, and he's spent years in the business world working with companies like NEC, Motorola, and TOTVS. And get this, he's also a huge blockchain enthusiast.
I have to say, I find it really intriguing how he combines traditional business thinking with this cutting-edge technology.
Yeah, it definitely shows that he's tuned into the future of finance. When you look at the big picture, the internet has completely changed the game. Think about it. E-commerce has erased geographical boundaries so businesses can reach customers all over the planet.
It really is a 247 global marketplace, isn't it?
Yeah. And all of this online activity generates mountains of data, which savvy businesses are using to automate, make smarter decisions, and even personalize customer experiences. Imagine seeing an ad for the exact thing you were just browsing online. That's the power of data.
Absolutely. The way we work has been transformed too. The gig economy is booming, with people freelancing, working remotely, and forging their own career paths.
It's a whole new world compared to the traditional 9-to-5.
And this digital boom is creating a ton of new job opportunities in areas like software development, data analysis, and digital marketing.
It's an exciting time to be in the tech space, that's for sure. And let's not forget about the impact of startups.
Yeah.
These agile, tech-savvy companies are disrupting entire industries, forcing established businesses to adapt or risk getting left behind.
Disruption is a powerful force. It pushes us to rethink what's possible and keeps things moving forward. But amidst all this change, it's crucial to remember the role of finance plays in this digital revolution. Professor Antunes is very big on creating real economic value for shareholders.
So that's all about making sound decisions that lead to profitable businesses. But what exactly is the role of finance in the digital age? Is it simply about chasing those quick wins?
Well, it's much bigger than that. It's about providing a framework for sustainable growth. Think of it as the backbone of any successful digital business. Finance helps businesses make smart investment decisions, manage risks effectively, and generate consistent cash flow. It's about maximizing returns while always keeping the goal of creating shareholder wealth in mind.
So it's more about long-term success and making the numbers work over time.
You nailed it. It's about understanding the cost of every decision and choosing the path that leads to the greatest long-term value. One of the core concepts that Professor Antunes emphasizes is the importance of operational cash flow, or EBIT. It's essentially the lifeblood of any business, especially in the fast-paced digital world.
And it's directly tied to his focus on shareholder wealth, right?
Yes. If a company is generating strong cash flow, it can reinvest in growth, pay dividends, and ultimately increase the value of its shares.
So a strong cash flow equals happy shareholders.
You could say that, and it's not just about generating cash flow, it's also about understanding the cost of opportunity. In the digital world, there are endless opportunities competing for your attention and investment. Finance helps you evaluate those options, weigh the risks against the potential rewards, and ultimately choose the path that aligns with your overall goals.
Okay, I'm starting to see how finance acts as a guide for navigating the digital landscape. So it's about making strategic choices based on a solid understanding of the financial implications.
Yeah.
And not just saying yes to every shiny new opportunity.
That's a great way to put it. And with this foundational understanding, we can now move on to two key metrics that are absolutely essential for any thriving digital business: LTV and CAC. Buckle up, because this is where things get really interesting.
I'm ready to unlock the secrets of digital value creation. Let's dive in. All right, so you mentioned LTV and CAC. Those sound like some pretty important metrics for digital businesses. Can you break those down for me?
You bet. So LTV stands for lifetime value, and it basically tells you how much revenue a customer brings in over their entire relationship with your business. Imagine if you could predict the total amount of money that each customer would spend with you. That's the power of LTV.
Oh, so it's about building those relationships that keep customers coming back for more?
Yeah.
They're not just focusing on one-off transactions?
Exactly. It's about maximizing the value you get out of each customer relationship. And then there's CAC, or customer acquisition cost. And this is the average amount you spend to bring in a new customer. So think of it as like the investment you're making to reel in each new client.
Okay, so LTV is about maximizing revenue from your existing customers.
Right.
And CAC is about minimizing the cost of getting new ones. But how do these two concepts work together?
Well, the magic really happens when you compare your LTV to your CAC. This is where you find what we call the golden ratio for a healthy digital business. You ideally want your LTV to be at least 3 times greater than your CAC. Professor Antunes actually provides a great example in his course material to illustrate this. He walks through this scenario, where for every $1 invested, the return is $4.21. That's more than 4 times the initial investment.
That's an impressive return. But why is that 3.1 ratio so important?
Well, it's a key indicator of sustainable growth and profitability. If your LTV is significantly higher than your CAC, it means you're earning more from your customers than you're spending to acquire them. But if your LTV is much lower than your CAC, you're essentially losing money every time you attract a new customer.
That's not a recipe for success.
Not really, no.
Okay, so if my LTV is kind of lagging behind and my CAC is through the roof, it might be time to look at my marketing strategies. Maybe I'm not targeting the right audience, or my messaging just isn't hitting the mark.
You're getting it. It's all about analyzing those metrics and figuring out how to optimize your marketing spend. Are you getting the most bang for your buck? Are there platforms where you're wasting money on that aren't delivering results?
Right. And what about pricing?
Oh, yeah.
Can LTV and CAC inform my pricing strategy?
Absolutely. If your LTV is significantly higher than your CAC, you might have some wiggle room to increase prices without scaring away customers. Conversely, if your LTV is barely covering your CAC, you might need to adjust your pricing downwards or find ways to increase customer lifetime value, perhaps through loyalty programs or subscription models.
So it's a balancing act. You're constantly trying to find that sweet spot where you're maximizing profitability without making it harder to attract new customers.
Precisely. And remember, these numbers aren't static. They'll change as your business grows and as it adapts to market conditions. So it's an ongoing process of analysis, optimization, and fine-tuning.
I'm starting to see how these metrics can be powerful tools for any business owner. But even with a good grasp of LTV and CAC, you need a solid plan to guide your business, right? You need like a blueprint for success. So that's where the business plan comes in. Let's talk about that. Let's talk about how we translate these financial insights into a tangible plan.
You're exactly right. It's time to shift gears and talk about the art of creating a solid business plan. In the fast-paced world of digital business, a well-crafted plan is like a compass, guiding your journey and keeping you grounded.
Okay, so you're saying a business plan is so crucial in this digital world. What are the key ingredients that go into making a solid business plan?
It all starts with pinpointing a problem or a need that your business aims to solve. You need to ask yourself, what gap are you filling in the market? What pain points are you addressing? And this forms the foundation of your value proposition. The reason that customers should choose you over the competition.
Right. So it's not just about having like a cool product or service.
Right.
It's about solving an actual problem that people actually care about.
You got it. And once you've identified that problem, you need to figure out, who are you solving it for? Defining your target market and ideal customer is key. Think about their demographics, their behaviors, their aspirations. The more you understand your target audience, the better you can tailor your product, your messaging, and your marketing efforts.
It's all about that laser focus, right?
Yeah.
Just making sure you're speaking directly to the people who are most likely to benefit from what you offer.
Precisely. Once you've nailed down your target market, you need to map out your revenue model, pricing strategy, and sales channels. How will you actually make money?
Right.
Will you sell products directly? Offer subscriptions? Use a freemium model? What pricing structure makes sense for your target market? And how will you actually reach your customers? Will you rely on online advertising, social media marketing, content creation, or a mix of different approaches?
So this is where the rubber meets the road.
Right.
You're turning your vision into a concrete plan for actually bringing in revenue.
Absolutely. And of course, no business plan is complete without financial projections. So you need to forecast your sales, expenses, and profitability. This helps you figure out, how much funding you're going to need and demonstrate the financial viability of your venture to any potential investors.
Makes sense, but this is starting to sound kind of overwhelming. Can you give me a real-world example to show how all these pieces actually fit together?
Sure. Professor Antunes actually provides a really interesting case study in his course about a company he refers to as Empresa A. And they operate in kind of a niche market, offering innovative soil stabilization solutions, from a U.S. firm to the Brazilian market.
Soil stabilization, that's pretty specific.
Yeah.
What makes their solutions so innovative?
Well, they're bringing a cutting-edge soil stabilization technology from the U.S. and introducing it to the Brazilian market. And their projected revenue for next year is over $14 million with an estimated valuation of $42.5 million. They've also managed to attract top talent. They have 3 experts trained in the U.S. It's a great example of how a well-defined business plan combined with specialized expertise can set you up for success, even in a niche market.
That's a really compelling example. So let's say you've got your business plan in place and you're starting to gain some traction. How do you actually determine the value of your digital business?
Well, that's where valuation comes into play. And one of the most common methods is called discounted cash flow, or DCF for short.
DCF, okay. That sounds complicated.
Well, not really. It's essentially about projecting your future cash flows.
Okay.
And figuring out your cost of capital and factoring in perpetuity, which is basically just like your long-term growth rate.
Yeah.
Think of it as a way to calculate the present value of your future earnings.
Okay, so you're looking into the future and then translating those potential earnings back into their value today. That's interesting.
Exactly. And a key part of the DCF calculation is something called WACC, or weighted average cost of capital.
More acronyms, all right. What does WACC tell us?
Think of it as the average rate of return that a company needs to earn on its investments to satisfy both its lenders and its investors. Like imagine, you're balancing a scale.
Okay.
On one side, you have debt, which is represented by the cost of, borrowing money. And on the other side, you have equity, which is represented by the return investors expect. So the WACC is essentially the point where that scale balances. It takes into account the cost of debt, the cost of equity, and the overall mix of debt and equity that the company's using, also known as its capital structure.
Oh, so it's like finding that point of equilibrium where everyone who's invested in the business feels like they're getting a fair return.
Yeah, that's a great way to think about it. So once you've got a good handle on your valuation, then it's time to explore the world of funding.
Funding, the lifeblood of any growing business. So what are my options here? I feel like there's a lot of different terms being thrown around, like angel investors, seed funding, venture capital. It's confusing.
Well, don't worry. It's not as complicated as it sounds. You've got a whole range of options, from, angel investors and seed funding to venture capital, private equity, and even debt financing. Each stage has its own characteristics and expectations. Angel investors typically come in early, providing capital and mentorship to startups. Seed funding helps you get your product off the ground, gain some initial traction. Venture capital kicks in when you're ready to scale your business rapidly. And private equity usually invests in more mature companies, providing capital for expansion or acquisitions.
So it's like climbing a ladder.
Yeah.
You're starting with smaller investments and gradually attracting those larger sums as your business grows.
That's a good analogy.
Yeah.
And no matter what stage you're at, you're going to need a killer pitch deck to capture the attention of investors.
Okay, so what exactly is a pitch deck? And what makes it so killer?
It's basically a concise and compelling presentation that showcases the key aspects of your business.
Yeah.
You'll want to highlight the problem you're solving, the solution, your target market, your business model, your traction metrics, and your team's expertise. Think of it as like a mini movie trailer for your business.
Oh, okay.
It's your chance to tell your story.
Gotcha. So what would you say is the most important element of a pitch deck?
Well, it's the ask. This is where you clearly state how much funding you're seeking and how you actually plan to use it.
So it's not just about asking for money, it's about presenting a clear vision for how that investment is going to fuel growth.
You nailed it.
Awesome.
And that, my friend, brings us to the end of our deep dive into the world of digital business finance.
Wow. What a journey. We covered so much. I feel like I have a whole new understanding of how businesses can thrive in the digital age.
Well, the real learning starts now. The challenge is to take these principles and apply them to your own life or business.
That's a great point. So for all of you listening, I have a question for you to ponder. How could you apply, say, the LTV-SAC ratio to your own personal finances or career choices? It's a concept that stretches way beyond just business. Think about it. Explore it. See what you discover.
I couldn't have said it better myself. We encourage you to keep exploring this exciting world of digital finance. The more you learn, the better equipped you'll be to navigate the opportunities and challenges that lie ahead.